Today, non-banks bloom as credit impulse slows again. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. It's the last working day of the month, and so both the RBA and APRA have released their monthly credit statistics. And so we're going to look at those in more detail. And there are a couple of really important themes coming through. Firstly, we see that credit growth continues to slow. And we also see that more lending is differentially being picked up by the non-banks, which of course are less well regulated and present, potentially at least, a higher risk. And by the way, if you get value from our posts, please do consider supporting our work. You can make a one-off contribution via PayPal, here's the link, or join our Patreon program where you can contribute on a monthly basis and also get access to additional content. Again, here's the link, and both links are in the comments below. So now let's look at the data in more detail. And we're going to start by looking at the RBA data. So the first chart here relates to the 12-month credit aggregates and shows the growth rate. So overall housing is now at 4.2% on an annualised basis, and that's down from 4.4% last month and continues the slow slide over the last few months. Owner-occupied housing is down to 5.9%. Now that's the first time it's below 6%. For a number of years, you can have to go back all the way to 2015 to find a growth rate as low. Investment credit growth has dropped to 0.9% on an annualised basis, and that's as low as it's been for a very long time. Turning to personal credit, that continues to shrink, although the rate of decline has eased just a little. Business credit is moving up, and all credit is at 4.2%, which happens to be the same number as housing credit overall. So this is a chart to underscore the easing of credit momentum in the housing sector. Now, the seasonably adjusted RBA data showed that last month, total credit for housing grew by 0.31%, up $5.6 billion to $1.81 trillion, which is another record. Now, within that, seasonally adjusted owner-occupied lending stocks rose 0.42% to $1.22 trillion, and that was up $5.11 billion. Lending for investment property rose just 0.09% or $0.5 billion to $595 billion. Personal credit fell slightly, down 0.07%, and business credit rose 0.42% to $960 billion and is up $4.06 million. And overall, the proportion of loans for investment purposes is now around 33%. And the final thing to notice is that the share of lending for business purposes is sitting at around 33% as well, and has remained relatively static as a proportion of all lending. Now, the next thing that we can look at is the monthly ADI portfolio growth by loan type, and we can track that by the market as well as by owner-occupied and investment lending. And we can see that the trends have been relatively volatile, but mostly in positive territory through the last few months. But sitting now at 0.38% for owner-occupied lending, 0.3% for all household lending, and flat for investment loan purposes. It's worth noting also that there was a slight uptick in January, and that's because, of course, in January a lot of people take leave or on holiday, and the auction season takes a breather. So it's no surprise to see that the volume is up just a little bit. The overall momentum is still relatively weak. Now, we can also look at the loan portfolio movements of the individual lenders. This is not, of course, seasonally adjusted data from APRA, but it gives a bit of a flavour as to how individual banks are actually faring at the moment. And so if we start with Westpac and CBA, we see some quite interesting movements there. Both grew their owner-occupied portfolios in the month, CBA more than Westpac. But on the investment side of the house, Westpac grew theirs, whilst CBA lost a small amount of share. Looking at National Australia Bank and the ANZ, well, NAB grew their owner-occupied portfolio but lost momentum in the investment sector, and ANZ saw a fall in both owner-occupied and investment lending. And that, I think, explains why ANZ came out recently saying that they'd been too rigorous and conservative in their lending standards for investment loans, and they offered, of course, this new 10-year interest-only loan for investment. You can see why they're trying to regain some ground. Looking then at some of the smaller players, minor movements up and down. ING had a pretty good rise in terms of volume, but the standout is actually HSBC, who grew their portfolio more than the majors. And considerable proportion, of course, was owner-occupied loans, but they also wrote quite a few investment loans. And that seems to be a bit of a trend where people are going away from the big four towards some of the other players. Macquarie was also quite active, members' equity, particularly on the owner-occupied side. And there was a small amount of activity at the AMP and in Citigroup. But this gives quite an interesting feel for where the momentum is and how the competitive dynamics are playing across the sector. So now we look at the home loan market share by owner-occupied and investment lending. And we start with the two big players, Westpac and CBA. And for owner-occupied lending, CBA is still somewhat ahead of Westpac. Next, we have National Australia Bank and ANZ, somewhat behind, and then the regional players. But on the investment side, Westpac is leading the pack ahead of CBA, and we see that ANZ is in fourth place. Again, perhaps explains why they're trying to court some more property investors. And then the regional banks follow, and some of the smaller players. And it's worth saying that HSBC, although we noted earlier, has grown their portfolio quite significantly, they're still a small player and are very heavily reliant on mortgage brokers. Now, there is one chart which I'm going to continue to show for a little while longer, and that's the 12-month monthly movements of the investment portfolios. Now, of course, the old 10% speed limit has pretty much gone now. So at one level, you could say that because of APRA's change of tune, it's not relevant. But it is quite interesting. The market over the last 12 months amongst the ADIs on an averaged monthly basis was 0.6%. And we see Macquarie out in front with the HSBC following on, and then a couple of smaller players, and then the more major banks bunched around the middle of the pack, and some of the other players like Suncorp and AMP and ANZ down on the negative side of the ledger as well. Now, there's one more thing I want to talk about, and that is the non-bank sector. Now, this chart shows you the relative performance of the non-banks relative to the majors. And it's worth noting you have to impute these numbers based on the difference between the APRA numbers and the RBA numbers. But my calculation is that the non-banks have an owner-occupied growth rate over the last year of 17.6%, which is significantly higher than the banks. And the non-banks are also growing their investor pools more as well, at 4.8%. Remember that the overall growth rate was below 1%. Now, this raises a really interesting question as to what the non-banks are up to. We know that they are under less strict controls from a lending standpoint. They have significant funding available, some from hedge funds. And we also know that they're offering a number of near-prime and subprime offerings. So our hypothesis would be that people who've been declined by the major banks are going to the non-banks as well as the small banks. Now, there's one last piece of data that's worth sharing, and that's to do with the non-bank share of housing lending relative to the total lending pool. And this chart shows the trend over the last few years. Back in February 2015, it was around 7.75%. It went down in December 2016, and then it started to rise again. And we're now back up at a similar level. So in February 2019, we're back up to 7.75%. And the other thing that's worth pointing to are these peaks here and here, because those peaks are nicely correlated with the announcement that APRA made with regard to tighter lending standards. So as APRA tightens the screws on the main banks, we are seeing more people go to the non-banks. And that's pretty definitive evidence, I think, that the non-banks are picking up the slack, but perhaps also building their risks higher than many expect or see. So to conclude our analysis, I think there are 3 points worth making. Firstly, overall the credit impulse continues to slow, and that means that we're going to see more downward pressure on home prices. Now remember that February was essentially the month in which Hain reported. So we might see some momentum increase ahead as the banks loosen the taps a little and ANZ's strategy plays through. I also think that there is a little bit of a tendency for some investors to think about buying investment property before the election, or indeed before the planned implementation of Labour's negative gearing policy. Now, interestingly, today they announced that they would implement these strategies from 1st of January next year if they were elected, which was sooner than people expected. So there may well be a little bit of a herd mentality, but remember that investors will be buying into a falling market, so that's a pretty tricky and risky scenario. So my own view is that's not going to be a particularly powerful force in supporting home price growth ahead. The other thing to think about is this non-bank phenomenon, where we continue to see the non-bank sector lending more aggressively relative to the rest of the market. Now, APRA, ostensibly at least, has responsibility for non-banks, but we don't think they're doing that much. We also don't think that the non-banks' risk management processes are as good necessarily as they would claim. And we know, looking at history, immediately before the GFC, it was the non-bank sector who was picking up the slack, and in fact they were the ones that caught the biggest cold when the property market crashed. So I suspect that we're going to see significantly higher risks in the non-bank sector, and I'm afraid that this is another signal that APRA is asleep at the wheel. The third point to make is that on these numbers, overall credit growth is still positive. And that means that household debt to income ratios are likely to continue to deteriorate because households are still borrowing, particularly for owner-occupied mortgages, at a time when their incomes are flat and at a time when home prices are falling. So again, this calls out more risks in the system. If you found this a useful post, please like it, share it, add a comment or a question. I read them all. And if you haven't subscribed yet, do so that you can receive future alerts. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.